So observing that, okay, we've lost reliability. Why? Okay, go back and have a look at every one of them. Well, how would I have avoided that? If I shift the stop to this level, below that, I've actually eliminated 90% of the losing trades that suddenly developed.
Peter Varcoe, welcome on the podcast. Good to have you here today. Good to talk trading, of course, and pleasure to meet you.
Nice to meet you, Etienne.
Let's start with this now. You're someone who I never spoke to before. You're someone who I read your book in the past. But tell me a bit more about kind of how did you start trading in the first place?
We're going back to 1999, 25 years ago. Overall, it's a fairly long story, but basically, divorce, asset settlement, housing prices depressed in the area at the time. The wife's lawyer insisted the property be sold, although I wanted to maintain till asset prices came up. So basically, the property got sold and still owed the bank money, and I got all of that sorted out and woke up at 43 with nothing. I was working for a franchising company at the time, and I came across guys that were actually looked like they knew what they're talking about. Had a look at the product, spoke to a lot of the clients, liked what I saw, and I started with that group, getting the education. And I actually liked what they were doing and what I was learning so much. I actually joined the company and became their Queensland manager in Australia. That was back in 2000. I started in September 99 with them, pure education. Then in 2005, I moved to another major group in Queensland. And then I just started doing private tutoring in 2009. And since then, I've been doing online mentoring since 2014 and just continuing that till current, along with other stuff that I'm doing.
Tell me about the learning curve of you trying to learn trading. Was it hard or was it pretty easy for you to get along with it?
It was the tech boom. Everything with .NET in it was going like that. Crazy. What you had to do was get into something with .NET in it, and it just made money. Well, that 6 months was just a dream. And then came the tech crash in 2000. And by then I'd learned enough about stops and trailing stops, and I actually got out, kept most of the open profit that was in each of the transactions at the time. The education with that group was really good. He was one of the best mentors I've ever had in my life, was Robert. And typical when that sort of thing happens, you're sitting there saying, "Where's this been all my life? How easy is this?" And well, after the tech crash, the next few months sorted that attitude out really quickly. So it was then just basically get down, do the work, learn, practice what you're learning, question it. If you can't make sense of it, question it. And Rob taught me something that I've actually passed on to every student I've been worked with since: is try and prove me wrong. By trying to prove me wrong, you'll learn more than you will just blindly following what I'm saying. It worked for me, and I've told every student since to do the same thing. Don't ever just accept what people are saying. Attempt to prove them wrong. You'll learn more that way.
What do you think is the difference between the guys who made money and lost it all in the crash in the market after like the dot-com bubble, and the guys who kept it like you? What made the difference there?
Mostly, though, the people who lost a lot of money didn't have sufficient knowledge looking over the whole thing. I mean, I go into this in detail. I've just released my second book, which is on trading plan, and risk management for those sorts of crashes are part of what I teach in that book. But at the end of the day, all these crashes are potentially perceivable. One of the things I did early in my education was I had data back to 1980. So I went back to 1987, and by mid 2000, just on what I'd learned from basic support and resistance, you'd have been out of most equities between 6 and 8 weeks before the crash in October of 1987. You have a look at that market was a 5.25 year bull run from 82 into October 87. The crash at the end of 2007 was easily understood when, and not necessarily when, but the fact that it was going to end was easily understood when you look back in history. These massive bull runs just do not continue. They always fall. It's just a fact. So coming into end of 2007, we had a 4.5 year bull run. That's only three-quarters of a year less than the crash of '87. And then you started getting the volatility and the wild fluctuations from about September of 2007, and you just knew that the end was coming. So you just got to position yourself and get ready for it. And another example I give in that trading plan book is the decoupling of the euro from the franc from the euro. The Swiss National Bank did the decoupling in January of 2015, and you could tell something was going to happen. The range of movement of each day was about 50 or 60 pips. Suddenly it closed down to 6 to 9 pips. That's something that's happening. Someone's moving stuff around then. So then basically I went to the currency futures contracts and I looked at the January, February and March contracts, and the volumes were enormous. The open interest was, well, of course, because they were unfilled. Most of them were unfilled at that point in time, so it was just pure open interest. The volumes were enormous, so you knew something was going to happen. What was it? Didn't know, but something's going to happen. The big boys are positioning themselves. So on H4, one of the franc pairs formed a descending pennant. So I actually entered the pennant, and that entry was about 4 days, 3 or 4 days before the decoupling. So you if you know what to look for, where to go looking for clues. I mean, you've got to be a detective in this industry. If you want to avoid getting caught by crashes, you've got to be a detective in some way, shape, or form. You've got to have an inquiring mind and go looking. If you don't, if you just blindly follow what other people are saying, then you're going to get hurt. You're going to get caught.
What was your training style from the first few years, and is it still the same style you use right now these days, or has it changed a lot over your learning and trading?
Initially, I was taught trend changes, just trend changes on equities on weekly, and then I was taught patterns, and that's basically all I did for 10 years. Just trend changes and patterns. Uh, Patterns I tended to specialize in because I love the subjective nature of them, and there's a lot of rubbish written on them. Every dog and his would-be author are trying to write about patterns, but all they're doing is regurgitating the same product, the same words. I had the two big encyclopedias, the McGee and Edwards and the Bulkowski encyclopedias, and they were just full of words but no real meanings. There was no really indicative way to trade them, no specific identification criteria or confirmation for higher probabilities. So I went searching for a lot of that, and found some methodologies there that do give you a higher probability, especially on triangular formations. There's very specific breakout window on triangular formations, and outside that, your probabilities drop immediately to 50% or less. So, and that just takes a lot of work and a lot of time and a lot of exercise.
Was that more intraday, or was it more swing trading?
No, what people classically call swing trading is often reversals. I actually work on the reversal signals rather than the actual the high and low turning point. I want to see confirmation of directional change as well. But that sort of came later. That didn't I didn't get into reversals until probably about 2012. Up until about 2010, it was rising support, falling resistance breaks for trend changes. And even that is not as simple as just putting on a line and taking a break of the line. There are areas of confirmation that you can use to get higher probabilities. There's an old saying in the industry, well, in any industry, if one thing gives you an answer, there's a probability of failure and a probability of success. If two different things give you the same answer, you've got a higher probability of success, which is why I always look for confirmation in some way, shape, or form before I enter anything. It does tend to cut out a lot of losing trades. But yeah, trend changes and patterns up until about 2009, 2010. And then I started looking at more continuation patterns, more continuation entries and reversals, and spent a lot of time on those, developing reliabilities for those. But that's basically it. Essentially, you're looking at directional change, trend changes, and patterns, and then external other continuation entries and reversals. They're basically the four different structures that I use.
What kind of time frames do you look at to identify trades? Is it more like intraday lower time frames or higher time frames, or?
No, I'm a social animal. I can't spend 9 hours a day in front of a computer screen looking at 5 minute charts. I go crazy. Um, I work predominantly on daily and H4. I find there's a lot of noise. When you get sub H4, there's a lot of noise. And the other thing that a lot of people don't realize is their platform's timing can be a big effect on your consistency. Right? Trading platforms are either GMT plus or minus zero or GMT plus or minus two, well, plus two. But then in summertime, they go to GMT plus one and GMT plus three. And the problem with GMT plus or minus zero is that you've got a 2 hour day on Sunday when Frankfurt opens at 10 p.m. Eastern time. Then you've got four 24-hour days, and then you've got one 22-hour day. So that screws up anything that uses an average is automatically screwed up because you've got six trading periods. If you're looking at daily, for argument's sake, you've got six trading periods, one of 2 hours, four of 24 hours, and one of 22 hours. So, say a moving average for the week is totally different on that platform than it is on one that's GMT plus two, which basically shifts the timing so that the market opens at midnight, that European time, and then you've got five 24-hour days in the week. So your moving averages are normally worked off closes. So as you can imagine, when you look at a 2 hour difference in each day, the closes are going to be different. Therefore, your moving averages are going to be different. Therefore, your MACD is going to be different. And anything that means moving averages or combined averages of anything is going to be different. The RSI is going to be different because it measures the up closes versus the down closes. And when they're different, everything changes on the charts and on the indicators. And most people just don't understand it. They don't understand that that difference, and it makes a big difference to the way the charts look as well.
That only affects the forward chart and above, though, no?
2 hours and above. Right, on MT5 you can go to 3 hour, but yes, sub 2 hour and sub 2 hour makes no difference. But on anything above 2 hours, it makes a big difference too. And for me, I work on daily and H4, so it makes a big difference for me overall. But also when you're working on equities on those charts, yeah, longer time frames on equities keep a lot of the noise out of it. So that just again, if you're looking at equities on a Forex platform that's on GMT plus or minus zero, that creates a big difference in anything using averages that you're using to identify or confirm anything. And most people don't realize it. They don't know the timings. They don't understand how it affects anything, and that is a big that catches out a lot of people. Most platforms use GMT plus two, but it's a handy question to ask your platform. Which one are you using?
Yeah, depend on the broker too. Yeah.
Yeah, exactly.
You mentioned you made the switch from equities to futures and forex in a few years ago. What made you change to forex and futures?
Well, working on equities on weekly, there's a lot of other time. So I actually started doing futures on in 2010 on weekly and daily, and then about 2012 or 2013, I started working forex daily as well. And at about 2015, I added forex on H4 as well.
Was it a change in the market or something different, or
No, well, it's just different markets. Agricultural futures can be quite seasonal, so you've got to take that into account. So it's a mental exercise, and you know, keeping your brain working is a good thing. Letting it sit there and stagnate, it's like muscles. You get fit and you stop using your muscles, you're going to lose them. Well, the brain's similar to that in many ways. Chemically, if it no such thing as chemical imbalance, but the chemistry changes and you're just not as alert, you're not as observant. And that's another thing in this industry. You've really got to be observant of price action because it does change. Most people in the industry, I'll take patterns as an example because I spent so much time and effort on patterns. And that was my first book, was specializing in patterns. There's a lot of stuff written and it's all the same basic stuff. What people don't think through is that they think everyone's their enemy on the markets and everyone's against them or they're against everyone else. What they've got to understand is most people know the same basic stuff about patterns, and therefore they know where the basic stops go, as a prime example. And this is where the market's changed in late 19, early 20, and then through to 21, and they've remained the same since, is that the patterns lost a lot of reliability. So flags, pennants, and triangles, for argument's sake, they lost a lot of reliability because where the basic stops were automatically placed by people who've read all the basics on them. And the reliability went down. So I just spent time looking and observing, and you could just see it happen. You could see the manipulation. So I changed the stops on them, and I got the reliability back. But if you're not observant of price action and being able to look at changes, then you're not going to pick up on that, and you're going to lose your reliability. And all it is just the big boys pushing price around, and they're not out there to get the average trader. We don't have the volumes that they require. But they know where the other institutions are putting their stops, so they'll just crash the pricing down straight through there to pick those orders up as their liquidity. And they're not chasing you or me. We're not big enough for them to chase, but they'll chase other banks on that. And so observing that, okay, we've lost reliability. Why? Okay, go back and have a look at every one of them. Well, how would I have avoided that? If I shift the stop to this level below that, I've actually eliminated 90% of the losing trades that suddenly developed because of manipulation in the price action that's actually changed in late 19 and early 20. So you do have to be a bit of a detective, and you do have to be observant if you want to stay successful. Constantly changing. Everything changes constantly. These financial markets are no different, really, when you actually look at them.
Right, but that's a good point. It's not about learning the technique once, then you're good for life. It's about learning the skills that you need to maintain that technique over time.
Yeah, that's a very good way of putting it, Etienne. Very good way of putting it.
Now, you trade weekly charts, and for some people, weekly charts would be so boring and like so, like I guess low effort because you just look at the chart a few times a week and you're good. Why do you love weekly charts?
On equities, because there's so much daily noise and fluctuations on equities in each and every day. Weekly charts on equities tends to cut out the interdaily noise or the interweekly noise, and you tend to get more reliable longer run instead of being constantly in and out. Works very well on equities. Doesn't work well on Forex. It can be worked on Forex. You can. I know one trader who's a very good friend of mine. He works off daily and weekly, and all he does, he sits there and watches all. He doesn't even sit there watching that much. He develops the main zones of reversals that they have, and when it's heading towards that reversal, he just places the relative order to catch the change of direction, because essentially a lot of the pairs range between certain boundaries. He doesn't put stops on. Therefore he doesn't get stopped out. He gets into a drawdown situation, but then when the reversal actually happens and gets past his entry, he's back in profit until it gets to the next reversal. So there's different ways of doing it. There's no single way of doing anything. Everything I do is just based purely and simply on price action. I look at the price, what it's doing, what it's telling me. It's like road signs. Every road sign will tell you something, but if you don't know how to read it, you're going to get lost. If you've ever been, are you in the States, Etienne, or whereabouts are you? In Thailand, okay. If you come from a country like Australia where we have one type of road sign, then you go to the States with those big clover leaves and the signs on that, right? You're used to the ones in Australia. I can read them. You go to the United States and go, holy snap and dooley, what is this trying to tell me? I do not understand it. And price action can be very similar. And you get volatility come into price action. And I'll go back to the euro franc decoupling. Suddenly you had all of these daily bars, ranges 3 pips difference, between 6 and 9 pips for the range for the day, open and close within 1 pip of each other in the middle of each bar for 9 consecutive days. Something's happening. They're building something up here. What are they trying to do? Where's it going to go? You can't just sit there and go, okay, well, I'm going to hold my long position. That's fine. I mean, look what happened to FXCM after the decoupling. They basically went broke. They had to get an emergency $300 million loan from Leucadia in the United States, and that didn't save them. They couldn't get back to a stage where they could actually make the loan repayments, and Leucadia sold them off to a European concern, and FXCM went from being the biggest broker in the world to being almost nothing these days. And that was caused by the euro franc decoupling. They were on the wrong side of it.
What would you tell the trader who's struggling, who wants to get consistent in trading? They want to have some results. What would you tell them to focus on first? Like, what's their action plan to get results?
People will probably say I'm being prejudiced because I do mentoring. But the biggest successes for me came from being mentored by two very magnificent mentors. Robert Lennox, who was he did all the training for Wall Street Group when I first started with them in late '99, early 2000. Then he went to a group called Australian College of Financial Education in Queensland. I followed him there, and so I had constant mentoring from a guy who was very, very good at what he did. And then I met Leon Wilson in 2003. Um, Leon's one of these eccentric, is one way of putting it. He's a really nice guy, but he's been a developmental trader since the day he started, and his knowledge is incredible. And developed a very strong relationship with him over the years. He's written 3 books on the subject of trading. It's The Business of Share Trading, Next Step in Share Trading Success, and then Breakthrough Trading. And this is where I found out about authors and editors on books. You've got to be really careful with books because you don't know how much ends up on the editing room floor. Leon's book, Breakthrough Trading, was a repurposing, for want of a better term, of the RSI. Instead of being a range-bound indicator, he actually made it dynamic and wrapped the bands around price action. And it became extremely reliable. Wilson Relative Price Bands is the name of the indicator. You can get it on quite a number of Forex platforms. But I read the book and I said to Leon, I said, mate, the whole thing about, because I'd already spent 3 weeks with him down in Tasmania learning exactly what he was doing and how he did it. I said, the stuff's not in there. He said, yes. The editor cut out 125 pages from a 502-page book. And what they cut out was what they didn't understand, which was what made the whole process work. Same thing with Alexander Elder's first book, Welcome to My Trading Room. No one can make the system that Alex used. No one can make it work. And Alex has admitted that the editors cut a huge amount out, and a lot of that was the real meat of what made his system work for him. So it's all very well buying a lot of books until you understand that editors, especially Wiley book, right? I think Write Books is one of the biggest um, offenders here. They just cut out anything they don't understand, and if that's the main piece of what your work is about, well, you've got problems trying to make it work. Self-published authors, you're going to get a better result out of. So Leon's just waiting for the Breakthrough Trading book to come out of copyright, and then he's going to self-publish it with everything back in it again. But yeah, 2 great mentors, and they mean an enormous amount to you. You can bounce things off them. And a good mentor won't just immediately give you the answer; it'll make you think about it yourself.
I see your point. A lot of people are trying to find answers. Yeah, they want to know the clear-cut answers. They want to know the rule, the recipe to follow all the time the same thing. And sometimes that doesn't work. Or it's actually better to kind of get them to find it themselves and get them to rely on their own decisions eventually.
Yeah. And the other thing is, a lot of people attempt to make absolutes out of probabilities, and you can't do that. It's very, very difficult to make an absolute hard and fast rule about something when all it is probabilities, if that makes sense to you.
So you're saying like, oh, this is a 80% win rate, therefore next rate should be a winner. Is that what you're saying, or?
No, let me put it this way. I'll go back to a pattern example. Right? On triangular formation, the optimum breakout window is 65 to 80% of the pattern length. I've had traders come to me and say, so can I say that these things break out then? And I said, no, that's just the optimum time to break out for a trade. If you've got the most reliability on a triangular formation when it breaks out between 65 and 80% of the pattern length. 60 to 85% still works well. Outside of that, your probability immediately drops to 50% from about 75 outside of that window. But he was trying to make a hard and fast rule. So I have to take this at that break. No, it also depends on what price action is doing. Because you get the breakout, well, again, if it breaks out and closes back inside the formation, that's obsolete. Throw the thing away. You've lost everything. It's as long as it hasn't triggered your entry, you haven't lost anything. But that cancels the formation. Again, people try and make hard and fast guidelines and rules out of what is essentially probability of working. I'm trying to do the mental gymnastics. I had a couple of examples of it recently of traders who came to me and said, can I say this? And no, you're trying to make an absolute out of a probability. It's a difficult thing. I'm trying to put it into words that most people can understand, and that can be difficult sometimes. My head works differently to most people's.
What do you think is the hardest part of coaching traders? Is that the hardest part you told about, or is there something else that you find is difficult?
No, traders have got to be willing to learn. They've got to be coachable. If they're not willing to learn, they're not going to make it. And that goes for any industry. Right? A good discussion with a potential student before you take them on or before you work with them gives you an insight into whether they're coachable or not. And just like a job interview, you go for a job interview in any industry. Let's say you're an apprentice, you've got to be you're an apprentice for a trade. If you're not coachable, you're not going to become a successful tradesman. You're not going to become a successful carpenter unless you're coachable. If you already think you know it all, or I've read this book so I know everything. When I was working for other people and I was training their groups of students, ran into a lot of people who agreed with everything you had to say as long as it agreed with what they currently thought. The moment you stepped outside their current thought window, they threw it away. And there's a lot of people like that around. You've got to sort them out. And they've got to recognize that that's them and they're wasting their time. If they're not coachable and they've got this thought window and they're not going to think outside that thought window, then they're actually wasting their time as well. They're better off trying to go and find something else. And that really applies to every industry. The other thing with this industry is you've got all these spruikers out there telling you you're going to make a fortune in 3 months, or it's 3 months down the track you're going to be making 40% a month. Well, have you ever considered the compounding effect of 20 or 40% a month? For crying out loud, 5% a month compounded is 82% a year. How many people do you know make 82 or 100% a year? I know a few, and I'm in that bracket. But it takes a lot of time, effort, and energy to get to there. The way I put it when I'm talking to people about it is, think about this. You're in an industry where when you get to the pinnacle of your skills, you're in a position to be able to make a lot more money than a specialist doctor or a high-flying lawyer. How much time, effort, and energy did they have to put into it before they even laid hands on a client? For the doctor being a patient or a lawyer being a client, you're looking at 8 years for a doctor, and before they're flying alone, it's 12 years after your residency. Your lawyers, you're looking at high-flying lawyers, they're constantly studying and taking on new stuff. They've got to have open minds and be coachable. Same thing. So you've got to look on your education in trading basically as an apprenticeship. I've learnt this, I can progress to here. I've learnt that, I can progress to there. I can progress to here, and I can see my skills improving. And something I talk to every student about is, you're doing your back testing, which is basically practicing the skills that you've learnt. You've learnt this skill today. Go back and back test it on this. Keep track of all your achievements and your failures, just using that. Then the next time they've got something new, go back and test it on that same one. See how you've improved with what you already knew on that, and then see what this new technique has added to that. And that way they've got a visual effect of their progression as a trader. They can see the difference that they're making.
Yeah, it's kind of like being hands on. Otherwise, if they're always hands off and just learning theory, it doesn't really help too much. So.
Yeah, and it gets boring going back and testing the same pair over the same time frame. But that to me is, I found, the best way that you can actually see your progress as you're learning new things and adding those different skills to your tool bag. Go and retest the same thing, and then compare your results then to your results now, and you've actually got a visual, effective difference between the two, and that shows you your progression. We've all got to do the boring stuff before we get to the really good stuff.
Tell me where people can find you and connect with you, and also feel free to let them know how they can find out your books and order them.
Easiest way to get me is email address is peter@petervarcoe.com. www.petervarcoe.com is the website. I'm available on WhatsApp on +507 6995 1705. That's my Panamanian phone number. It's also my WhatsApp. I'm also available on Telegram under Peter Varcoe. On the website, there's a page called Latest News. There's quite a number of articles there that I put there that are highly specific about things like trend line applications, and this is all about developing reliability. Um, and there's a lot of things in there, free resources there for people to go and have a look at, and everything else is on there. So it's not difficult to find. Just petervarcoe.com is the website. Peter@petervarcoe.com is the email.
We'll put the link below. People can check it out directly in the podcast show notes and the YouTube description too. You can check it out directly. I appreciate your time here, Peter, for sharing the advice to my listeners. I think it's a lot of good stuff for sure. Hopefully, people can learn from your lessons and they can apply this to their own trading. So feel free to reach out to Peter. Comment below with any questions you have. And
One of the things that I found just before you close, Etienne, one of the things I found interesting in your guide was what was the worst mistake. I'm assuming you mean apart from not starting 20 years earlier. Believing my biggest mistake was believing the platforms last. There's no crime involved. I had a situation in 2010, Sunray Capital Markets in Australia. $72 with $76 million of client funds was embezzled. Platform went down. How do you handle that? How do you handle when the platform goes down and you lose everything? MF Global in 2011, $1.5 billion missing. Crazy. Uh, and again, you look at risk management. That was where I developed some of the risk management structures that I use now. How do you get around that sort of thing? It's difficult to see that, especially the illegal stuff happening. It's difficult to see that. And I also go into the background on that in the trading plan book as well. And I wrote trading plan because it's an inglamorous subject. It's not a glamorous subject, but it's an essential tool for successful trading. Most people don't understand it. When I first started, it was okay. You got to have a trading plan. Well, good. What do I put into it? How do I do it? How do I structure it? Yada yada yada. And I developed a template for that over the years, and then I basically made a book out of the template. So it's a boring subject for most people, but it's an essential tool. But yeah, I mean, your worst trading mistake was believing the platforms last and not understanding that there is criminal involvement, embezzlement in the case of Sunray Capital Markets in Melbourne, in Australia. MF Global, $1.5 billion missing. Well, that is still an ongoing investigation, and the guy that was head of that was involved. I'm not going to say the surname in case I'm incorrect, but he was actually featured in the book Liar's Poker.
crazy stuff. Yeah, we can definitely talk about this in the future if you want. So people can comment with the questions, let their thoughts, and we'll catch you back here in the next interview pretty soon.